And after the tax is applied, the producer surplus decreases from here to here, and the consumer surplus decreases from here to here. And because of the tax, this is the tax revenue gained by the government. And in this video, I'm going to be guiding you through the tax diagram, which will be explained simply. First of all, we need to look at the free market, which is allocative efficient. As you can see, demand equals supply, consumer and producer surplus is maximized, and this is allocative efficient. If you want to recap on consumer and producer surplus, I have a video to that in the description below. So firstly, we're going to look at the impact of a tax on tax revenue. The first thing that happens when the tax is applied to the production of a good is that it decreases its supply from S1 to S2 plus tax. The result of this is that the consumers will pay a higher price of PC, which makes logical sense, but the other one is that the producers will be receiving less revenue. And the reason for this is that the tax is split between the consumers and the producers. Let me show you. Hypothetically, a government decides to add a $5 tax to a good. And this is represented by the distance of this red line from S1 to S2 plus tax. As our new equilibrium is now the intersection between D and S2 plus tax, and remember the distance between S1 and S2 plus tax is the value of the tax, which is $5. As you can see on the diagram, the distance between PE and PC is how much the consumers are going to pay extra. This isn't the full $5 tax which is imposed by the government. So the distance between PE and PP is the portion of tax that the producer needs to pay to the government, and this will be reflected in its revenues. So in my hypothetical case, the consumers are paying an additional, let's say, $3 per unit, and the producers are paying an additional $2 per unit, which means that the $5 tax is split between consumers and producers. As consumers are paying the additional price per unit from PE to PC, their total tax burden paid to the government is the purple area here, which is the tax per unit, which is the distance between PE and PC, multiplied by the new quantity, which is Q2. And same goes for the producer. As the producer is also paying a portion of tax, their revenue loss per unit is indicated from the distance between PE and PP. And if we multiply this by the new quantity of Q2, this is the total tax burden paid for by the producers. And this is the purple box shaded in here. And in the end, the government collects tax revenue from both the consumers and the producers, which is the distance between PC and PP, in this case $5, multiplied by the new quantity of Q2. And the purple box illustrates the total tax revenue received, and the welfare loss is created. More on this later. Moving on to the consumer and producer surplus. Let's start with the consumer surplus. The shaded triangle here illustrates the consumer surplus before the tax, as the maximum price that people were willing to pay is here, and the equilibrium price is here, which gives us the quantity of Q1, which gives us the consumer surplus. But after the tax, the consumer surplus falls as the maximum price that people are willing to pay is here, and the price has now increased from PE to PC, so the new equilibrium price is at PC here. And because of an increase in price, quantity falls from Q1 to Q2. And due to this mechanic, this gives us a smaller triangle shaded in blue. So in order to calculate the new consumer surplus, this is the maximum price that people are willing to pay, in this case P max, minus PC multiplied by Q2 divided by 2. And that gives us this small triangle here. And if you want to calculate the change, then it's the old consumer surplus minus the new one. And in the case for the producer surplus before the tax is shaded in yellow. So here is the price that producers are willing and able to supply their services or products to the market. I'm going to call this P min. But the equilibrium price is PE. We multiply this by Q1, which is the equilibrium quantity before the tax, divided by 2. Now, after the tax, the producer surplus falls as revenues received per unit goes from PE down to PP. And because there is less incentive to produce products into the market due to lower profits, quantity falls from Q1 to Q2. So the new producer surplus is the distance between PP and P min multiplied by the new quantity of Q2 divided by 2. Now moving on to the welfare loss. In the case for consumers, the consumers that were only willing to pay a price of PE are now completely priced out of the market, which results in a fall in demand. And at the same time, the producers that were willing and able to produce at PE will either lack incentive or find it unprofitable to receive revenues at PP. Therefore, they don't supply their products to the market. So we know that the consumers are buying less and the producers are supplying less. But before the tax, these were mutually beneficial trades between consumer and producers. And because of the tax, these trades no longer happen. Moving on to taxing elastic and inelastic products. In the case for taxing an inelastic product, the consumer will have to pay more tax. This is because the demand curve is less responsive compared to supply. So let me give you an example. Cigarettes are price inelastic, so the quantity demanded will not be as responsive in the change in price. Simply put, most consumers will be willing to pay the higher price. And because producers know this, they are more than willing to pass on the tax burden to the consumers. You can see this on the diagram. As the hypothetical $5 tax is imposed, you can see that the tax paid by the consumer is higher compared to the producer, as the distance between PC and PE is significantly greater than the distance between PP and PE. So consumers are indeed the biggest losers when it comes to taxing an inelastic product. And in the case for an elastic product, things are quite the opposite, as consumers will now pay less tax when goods are elastic. This is because the change in demand is very sensitive to price increases. And one reason for this is a large number of substitute goods. If a single producer decided to pass on the full tax burden onto the consumers will just simply buy substitute goods at a lower price. I hope that helped. I hope you guys have a good day. Bye-bye.